Sounds simple, right? Just another mining headline. But what if this move isn't just expansion? What if it's timing? Record profits, high gold prices, hundreds of millions committed, right now. Why invest aggressively at this exact moment? What does management see that most investors don't? When companies expand at peak margins, it can signal confidence or it can signal preparation. Is this a calculated growth surge or a strategic positioning before something bigger unfolds in the gold market? Because when second largest players make bold moves, the ripple doesn't stay local, it spreads. And what happens next could reshape how investors look at gold in the coming months. Welcome to Market Metal. If you've been watching markets for years, maybe even decades, you already know the quiet moves often matter most. So before we continue, take a moment, gently press that subscribe button like you would turn a page in your favorite old newspaper. Stay with us and tell us in the comments, where are you watching from today? The timing of capital. Why expansion now matters. The headline appears straightforward. Expansion move could boost this Australia gold miner fast. Yet serious business observers understand that expansion is never just about growth. It is about timing. And timing in commodity industries can determine whether a company compounds wealth or destroys it. Evolution Mining AS' decision to move forward with major expansion projects comes at a moment when gold prices remain elevated by historical standards. Global uncertainty has not faded. Inflation pressures, while moderated in some regions, continue to shape monetary policy. Interest rates remain structurally higher than they were during the ultra-loose years following the global financial crisis. Meanwhile, central banks around the world have been increasing their gold reserves as a hedge against currency volatility and geopolitical fragmentation. These are not short-term fluctuations. They are structural forces. In such an environment, companies with exposure to gold face a strategic choice. They can conserve cash, return profits to shareholders, and wait for clearer signals, or they can deploy capital into high-return projects while margins are strong. Evolution Mining has chosen the second path. The significance of that choice cannot be overstated. The company reported record underlying profits for the half year, supported by strong gold prices and disciplined cost control. Its balance sheet remains robust, with substantial liquidity available to fund development internally. This matters. In previous mining cycles, expansion was often financed through aggressive borrowing. When prices fell, heavily leveraged miners struggled. Some were forced to sell assets, others diluted shareholders. The lesson from history is clear. Expansion funded by debt during peak prices is dangerous. Evolution's leadership appears aware of this history. By funding projects from existing cash reserves rather than relying heavily on new debt, they reduce financial fragility. They maintain optionality. They preserve flexibility if gold prices retrace. This is not a reckless expansion fueled by euphoria. It is a calculated deployment of capital during strength. However, the deeper question remains, why now? Gold prices have rallied in response to a combination of macroeconomic pressures. Investors remain cautious about long-term currency stability. Sovereign debt levels in major economies are historically high. Geopolitical tensions continue to reshape trade routes and supply chains. In such an environment, gold retains its appeal as a store of value. Mining companies benefit from these price dynamics, but they must also evaluate whether current prices are cyclical peaks or part of a longer structural shift. When a miner decides to expand during a period of high prices, it signals belief in durability. Management must assume that either prices will remain elevated long enough to justify capital outlays, or that the cost structure of new projects is resilient enough to withstand price volatility. In other words, they must believe that returns will remain attractive even under conservative assumptions. This is where capital discipline becomes critical. High gold prices can tempt executives to chase volume growth. The logic seems simple. Produce more ounces while margins are wide. Yet history shows that such behavior often leads to oversupply. As more projects come online across the industry, increased production can eventually pressure prices. The cycle turns. Those who expanded indiscriminately face compressed margins. Evolution's public messaging emphasizes return on capital rather than pure production growth. This distinction is subtle but important. Producing more gold does not automatically create value. Generating high returns on invested capital does. Investors and business leaders should pay attention to this difference. The selected projects, particularly expansions at North Parkes and Ernest Henry, are positioned as high-grade, high-return opportunities. A higher-grade ore generally means more metal extracted per ton of material processed. That improves efficiency, it lowers the break-even price, it strengthens resilience in weaker price environments. From a strategic standpoint, investing in quality assets during strong pricing cycles can be prudent if those assets remain profitable, even under stress scenarios. Timing also reflects confidence in operational capability. Expansion requires not only capital, but also execution strength. Workforce management, supply chain coordination, regulatory approvals, and engineering precision all play roles. Undertaking expansion during a volatile global environment suggests management believes it can control these variables effectively. That confidence, if justified, enhances long-term competitive positioning. Yet caution remains essential. Commodity markets are inherently cyclical. Even strong structural trends experience corrections. If gold prices retrace sharply, margins narrow. Projects that looked highly profitable under optimistic assumptions may deliver more modest outcomes. The real test of strategic wisdom is not how projects perform at peak pricing, but how they perform during downturns. For the business community and aspiring entrepreneurs, this case provides an instructive lesson. Expansion during strength is not automatically reckless. It depends on balance sheet health, asset quality, and disciplined capital allocation. Companies that expand with strong liquidity, conservative cost assumptions, and a focus on return metrics are fundamentally different from those chasing momentum. There is also a signaling dimension. Markets interpret expansion announcements as forward-looking indicators. When a major miner commits substantial capital to long-term projects, it communicates belief in demand stability and price resilience. Investors analyze these signals carefully. A disciplined expansion can strengthen market confidence and attract institutional support. However, prudent observers avoid emotional reactions. They assess fundamentals. They examine cost curves, reserve life, and jurisdictional stability. They ask whether expansion improves structural competitiveness or merely increases exposure to price risk. In Evolution's case, the internal funding of development projects reduces leverage risk. The focus on high return assets strengthens capital efficiency. The timing aligns with favorable macroeconomic tailwinds in gold markets. These elements collectively create a picture of calculated strategic positioning rather than speculative expansion. Still, the next phases will determine whether this move truly accelerates long-term value creation. Execution discipline must remain firm. Cost inflation in mining inputs, labor, energy, equipment, cannot be ignored. Regulatory conditions can evolve. Currency movements can alter cost dynamics. Each of these factors interacts with gold price volatility. Therefore, the expansion decision should be viewed neither as a guaranteed success nor as a speculative gamble. It is a strategic bet based on current macroeconomic signals, strong internal profitability, and asset quality confidence. For decision makers watching this development, the core insight lies in timing combined with discipline. Expansion is not about optimism. It is about calculated conviction supported by data. When capital is deployed during strength, it must be shielded by resilience. The coming quarters will reveal whether this conviction is justified. If gold prices remain supported and operational execution proceeds smoothly, the expansion could indeed strengthen the company's position significantly. If external conditions deteriorate, balance sheet strength will determine adaptability. In cyclical industries, survival and dominance often depend on decisions made during peak conditions. Expansion in strength requires clarity, not excitement. It demands sober evaluation of risk and return. This is the strategic frame through which this development should be understood. Return on capital versus volume growth. The quality strategy. Expansion alone does not create strength. In mining, the difference between strategic growth and destructive growth often comes down to one quiet metric: return on capital. When Evolution Mining announced its expansion plans, many observers focused on the headline number. Hundreds of millions in new investment, new development phases, larger output potential. But serious business leaders look beyond headline scale. They ask a more difficult question: will every dollar invested generate more than it costs? This is where the company's approach becomes more interesting. The leadership did not frame the expansion around increasing production for its own sake. They did not emphasize chasing ounces simply because gold prices are high. Instead, they highlighted return percentages. They spoke about project internal rates of return ranging significantly above the portfolio average under the current pricing environment. That language is deliberate. It signals a different philosophy. Mining history is filled with examples of companies that expanded aggressively during price rallies. They increased output rapidly. They celebrated higher volumes. Yet when prices corrected, margins collapsed. Capital that had once appeared productive turned into burden. Shareholders absorbed losses. Years of gains were erased. The danger in commodity industries is simple. Volume growth can feel like strength, but it is not always profitable strength. Evolution's stated focus on high-grade assets changes the framework. High-grade ore bodies allow more gold to be extracted from each ton processed. That improves efficiency. It lowers unit costs. It creates a cushion if prices decline. In volatile markets, that cushion becomes survival. The North Parks and Ernest Henry developments are positioned as quality-driven expansions. These are not marginal deposits brought online to capitalize quickly on price momentum. They are extensions of established productive hubs. That distinction matters. Established hubs already possess infrastructure. They already have experienced workforces. They already operate within regulatory frameworks. Expanding existing quality assets typically carries lower operational risk than launching entirely new projects in unfamiliar jurisdictions. From a capital allocation perspective, it is a controlled method of scaling. Yet there is another layer. By emphasizing return on invested capital rather than production growth, the company is indirectly communicating to investors that it is resisting market pressure. During bull cycles, markets often reward companies that promise higher output. Analysts build growth narratives around volume increases. Share prices can respond quickly to production forecasts. Resisting that pressure requires discipline. It means accepting that short-term market enthusiasm may be less dramatic. It means focusing on durable value rather than rapid headlines. This discipline becomes even more critical when gold prices remain elevated. High prices can create illusions of efficiency. Projects that appear profitable at peak pricing may struggle at normalized levels. A serious management team stress tests assumptions. They examine whether projects remain viable if prices retreat. They assess whether capital could generate better returns elsewhere. For entrepreneurs watching this decision, there's a broader lesson. Growth is not inherently good. Only profitable growth creates lasting value. In business, especially in capital-intensive sectors, leaders must distinguish between expansion that enhances resilience and expansion that increases fragility. The key variable is margin durability. If a project can sustain strong returns even when external conditions shift, it strengthens the enterprise. If it relies on perfect conditions, it introduces vulnerability. Evolution's portfolio reportedly averages solid returns in the current environment. The proposed projects promise even stronger returns under similar assumptions. This creates a hierarchy of capital deployment. The company is not simply adding scale, it is attempting to raise the quality of its asset base. That shift has implications beyond immediate financial results. Higher quality assets improve long-term optionality. They provide flexibility in allocating production schedules. They allow management to prioritize higher margin zones during downturns. They enhance negotiation power with suppliers and contractors. In cyclical industries, optionality is a competitive advantage. Still, the decision carries risk. Return projections depend on assumptions. Gold prices, cost inflation, labor availability, and exchange rates all influence realized outcomes. Mining expansions also carry technical risks. Underground development, equipment integration, and resource estimation accuracy can all affect timelines and budgets. A disciplined capital strategy reduces risk, but does not eliminate it. There's also competitive signaling to consider. When a major operator publicly commits to high return expansion, it sends a message to peers. It suggests confidence in the structural outlook for gold demand. It may encourage other producers to evaluate similar opportunities. If multiple companies expand simultaneously, industry supply can increase faster than anticipated. That dynamic has historically pressured commodity prices. Therefore, disciplined growth must remain selective. Now, the most powerful element in this expansion narrative is not speed. It is selectivity. The company is not expanding everywhere. It is targeting specific hubs with defined return profiles. That focus reduces dispersion risk. It concentrates capital where management believes competitive advantage is strongest. For serious decision makers, the message is clear. Capital must be deployed where structural edge exists, not where enthusiasm is loudest. In industries driven by cycles, survival often belongs to those who preserve margin integrity. Companies that dilute capital discipline during price strength frequently struggle during corrections. Those that prioritize return quality over volume expansion typically emerge stronger. The suspense in this development does not lie in whether output will increase. It lies in whether disciplined capital allocation can transform cyclical profits into structural strength. If the projects deliver returns consistent with management's projections, the expansion could materially enhance long-term resilience. If execution falters or macro conditions deteriorate sharply, even disciplined plans will face pressure. The coming quarters will test assumptions. For now, one truth stands. The difference between expansion and value creation is return on capital. And in mining, that difference determines who thrives when the cycle turns. Competitive positioning and industry. Signaling. In capital-intensive industries, actions speak louder than commentary. When a major operator commits nearly $1 billion to expansion, the market does not treat it as routine. It interprets it as a signal. Evolution Mining does not operate in isolation. It stands as one of Australia's largest gold producers, positioned just behind its closest peer in national scale. In such a competitive landscape, capital decisions influence not only internal growth, but also industry perception. Expansion at this level shifts expectations. The first layer of analysis concerns market share and positioning. In Australia's gold sector, size matters. Larger operators often benefit from stronger supplier relationships, better financing access, and greater operational flexibility. By expanding high-return hubs, evolution is not merely increasing output potential. It is reinforcing its status within the hierarchy of producers. But the more interesting question is strategic intent. Is this expansion defensive, offensive, or preparatory? If defensive, it could reflect a desire to protect long-term cost leadership before industry conditions tighten. If offensive, it may signal ambition to strengthen competitive standing and potentially close the gap with larger rivals. If preparatory, it could indicate belief that gold markets are entering a prolonged structural phase, requiring scale and efficiency to capture opportunity. Each interpretation carries implications. The share price reaction following the announcement offered an immediate market response. Investors tend to reward confidence when supported by strong balance sheets and credible returns. A positive reaction suggests that capital markets currently interpret the expansion as disciplined rather than reckless. However, markets can be optimistic in favorable commodity environments. Long-term judgment will depend on execution and price stability. Another critical dimension is jurisdictional diversification. Evolution's operational footprint spans key Australian assets and includes exposure to Canada. This geographic mix provides risk dispersion. Political stability, regulatory clarity, and infrastructure access are central variables in mining success. By strengthening established hubs within stable jurisdictions, the company reduces geopolitical unpredictability. That choice contrasts sharply with historical mining expansions into higher risk regions during commodity booms. In previous cycles, producers pursued rapid reserve growth by entering less stable territories. While some succeeded, others encountered regulatory setbacks, cost overruns, or operational disruptions. Expansion within secure, known environments lowers that exposure. Yet competition within safe jurisdictions intensifies. When a leading operator strengthens its most efficient assets, smaller competitors must reassess their positions. Companies operating marginal deposits may find themselves under pressure if larger peers achieve cost advantages through scale and grade improvements. In cyclical industries, competitive gaps widen quickly. There's also the consolidation question. Gold mining historically moves in waves of mergers and acquisitions following strong price rallies. Higher prices increase valuations and provide currency, through stronger share prices, for strategic deals. If disciplined operators enhance profitability through expansion, they may later use that strength to pursue acquisitions. This possibility adds another layer of strategic depth to the expansion decision. Serious observers recognize that organic growth and acquisition growth often operate in sequence. Strengthening core hubs first creates a foundation. Once capital efficiency is proven and liquidity remains strong, optionality expands. Expansion, therefore, can be both an immediate production strategy and a long-term consolidation platform. The industry-wide implications extend further. When a second-largest national producer invests heavily during a strong gold environment, peers interpret that confidence carefully. If competitors believe the cycle will sustain, they may accelerate their own projects. If they remain cautious, they may preserve cash and observe. Diverging strategies can define winners and laggards over time. There's also the macroeconomic signaling effect. Capital commitments in resource sectors often reflect expectations about demand durability. Gold demand is influenced by central bank policy, currency stability concerns, and global risk sentiment. Expansion implies management confidence that these forces will not reverse abruptly. However, disciplined leaders remain aware of supply dynamics. If too many producers expand simultaneously, incremental supply can pressure prices. Gold differs from industrial commodities, in that much of its demand is financial rather than consumption-driven. Investor sentiment can shift quickly. Therefore, timing and scale must align precisely with realistic demand assumptions. From a strategic standpoint, Evolution's measured approach, targeting specific high-return hubs rather than broad-scale expansion, reduces the risk of triggering oversupply. Concentrated investment strengthens competitive resilience without dramatically altering global supply dynamics. For business leaders and aspiring entrepreneurs, the lesson deepens. In competitive markets, expansion is both growth and message. It communicates management's outlook, risk tolerance, and confidence in structural demand. It shapes how competitors respond. It influences capital flows. The suspense in the stage of the narrative lies not in immediate output increases, but in positioning. When a leading producer strengthens its most productive assets during price strength, it builds strategic armor. If the cycle extends, it benefits disproportionately. If the cycle weakens, its higher quality portfolio offers protection. The coming quarters will reveal whether this expansion becomes a pivot point within the Australian gold sector. If returns materialize as projected and macro conditions remain supportive, the move could widen competitive distance. If cost pressures intensify or prices retrace significantly, the discipline behind project selection will determine resilience. In cyclical industries, leadership is often defined during moments of abundance. Expansion during strength requires clarity of vision and confidence in structural trends. Test management's ability to separate durable opportunity from temporary momentum. For now, the market watches. A major capital decision has been made. The signal has been sent. Competitors are observing. Investors are evaluating. The real question is no longer whether expansion will occur. It is whether this move will reshape competitive balance in the gold sector over the next phase of the cycle. Risk assessment, the strategic warning for decision makers. Every expansion story carries optimism, but disciplined leadership demands the opposite starting point. Before assuming acceleration, serious observers ask, where does this plan break? Evolution. Mining's expansion appears structured, internally funded, and focused on high-return assets. Yet even the most carefully designed capital strategy remains exposed to forces beyond management control. The final stage of this analysis requires confronting those forces directly. The first and most obvious variable is gold itself. Gold prices are elevated. They are supported by geopolitical tensions, persistent inflation concerns, sovereign debt expansion, and central bank accumulation. But commodity markets are not static. They oscillate. If global monetary conditions tighten further, if inflation subsides faster than expected, or if investor risk appetite shifts toward equities and technology assets, gold demand could soften. In that scenario, price normalization becomes the central risk. The true strength of any expansion decision lies in its ability to survive under conservative price assumptions. If projects remain profitable at lower gold prices, resilience is intact. If they rely heavily on peak pricing, fragility emerges. Investors must examine sensitivity models carefully. Margins that appear wide during strength can compress quickly during corrections. The second risk dimension is cost inflation. Mining is not immune to global supply pressures. Energy costs, skilled labor shortages, equipment procurement delays, and contractor pricing all influence project economics. During commodity upcycles, input costs often rise alongside output prices. If cost inflation outpaces gold price stability, projected returns narrow. Execution discipline becomes critical here. Budget overruns and timeline delays can erode the very returns that justified expansion in the first place. Underground development carries technical complexity. Infrastructure upgrades require precision. Resource estimates must translate accurately into recoverable output. A single miscalculation can materially alter return projections. The third layer of risk is macroeconomic. Interest rate environments influence capital flows into commodities. Currency fluctuations affect operational costs and revenue translation. For an Australian miner, exchange rates between the Australian dollar and the US dollar matter significantly, since gold trades globally in US dollars. Currency appreciation can compress margins even if gold prices remain stable. Regulatory risk also remains present. Environmental approvals, community engagement obligations, and evolving governance frameworks can extend development timelines. In mature jurisdictions, such as Australia and Canada, regulatory systems are stable but rigorous. Compliance delays can introduce capital strain if not anticipated properly. There's also an industry-wide dynamic to consider. If multiple producers interpret elevated gold prices as structural and expand simultaneously, aggregate supply may increase more rapidly than demand. While gold differs from industrial metals due to its financial demand component, incremental supply still affects price psychology. Oversupply does not need to be extreme to shift sentiment. Even moderate production growth can influence investor perception. The danger in any commodity cycle is collective optimism. Expansion during strength can appear rational at the company level, but when replicated broadly across an industry, it can create systemic pressure. Strategic leaders therefore monitor competitor behavior closely. The competitive environment must remain disciplined, or price stability can deteriorate. For entrepreneurs and business leaders outside mining, this case presents a powerful principle. Expansion should not be driven by momentum. It must be driven by structural advantage. A company with strong liquidity, high margin assets, and disciplined leadership can expand during favorable conditions without jeopardizing stability. A weaker company copying the strategy without those foundations risks severe consequences. Capital strength is not simply a resource, it is a shield. Evolution's internal funding approach reduces leverage exposure. That strengthens defense if macro conditions worsen. However, even internally funded projects require opportunity cost analysis. Capital deployed into expansion cannot be used elsewhere. If unforeseen disruptions emerge, flexibility narrows. Another critical dimension is strategic optionality. If gold enters a prolonged bull phase, expansion may accelerate earnings growth meaningfully. If gold stalls or declines, management may need to adjust production sequencing, defer additional investments, or optimize cost structures aggressively. The flexibility to adapt quickly will determine long-term success more than initial project enthusiasm. The suspense in this final stage lies in uncertainty. Markets reward bold decisions when they succeed. They punish them when timing proves imperfect. The current expansion plan appears measured and return-focused. Yet cycles are rarely linear. volatility remains embedded in global economic systems. High sovereign debt levels, geopolitical fragmentation, and currency realignment trends support gold structurally. But monetary policy pivots or unexpected technological disruptions can alter demand narratives swiftly. Gold's dual identity as both commodity and financial hedge means sentiment shifts can be abrupt. Therefore, the ultimate evaluation of this expansion will not depend solely on project metrics. It will depend on adaptability. If gold remains supported and execution stays disciplined, this move could strengthen competitive position significantly. If external pressures intensify, balance sheet resilience and cost control will determine survival margins. For serious decision makers, the lesson extends beyond mining. The question is not whether to expand during favorable cycles. The question is whether expansion is anchored in durable advantage and conservative assumptions. Growth that survives stress creates lasting enterprise value. Growth that depends on perfect conditions creates vulnerability. Evolution. Mining has signaled confidence through capital commitment. It has emphasized return quality over volume ambition. It has chosen internal funding over leverage expansion. Now the external environment will respond. The cycle will test assumptions, costs will fluctuate, competitors will react, markets will reassess. In cyclical industries, leadership is defined not during prosperity, but during volatility. The final outcome of this expansion will not be decided by today's gold price. It will be decided by how well strategy withstands tomorrow's uncertainty. And that is where the real judgment begins.